to manage changing market conditions. Its strong performance through the first half again highlights the value of our diversified business model and helped offset the pressures in fresh fruit. With that, I'll hand you over to Jacinta to give the financial review for the second quarter.
Thank you, Rory, and good day, everyone. Turning firstly to the group results on slide 11. Group revenue of 2.5 billion was 2.9% higher on a reported basis, reflecting positive operational performance across the group, together with favourable foreign exchange movements. Excluding foreign exchange impacts, on a like-for-like basis, revenue was 1.7% ahead. While revenue remained resilient, profitability was impacted by higher costs within fresh fruit, as discussed by Rory. Cost of sales increased at a proportionally higher rate than revenue, primarily reflecting the higher costs in fresh fruit, and as a result, gross profit decreased by $23 million. SMG&A expenses were higher year over year, primarily due to a non-recurring charge recorded in connection with the settlement of a historical legal matter. In Q2 2025, we booked gains from asset sales in Hawaii, which also contributed to the overall decrease in operating income. Offsetting this, other income increased by $22.6 million, primarily reflecting favourable unrealised foreign exchange movements on foreign currency denominated borrowings compared with an unrealised loss in the prior year. Interest expense decreased by $2.7 million due to lower average borrowings and lower base interest rates. Overall, net income from continuing operations was $35.1 million compared to $52.9 million in the prior year. However, total net income increased year on year as the prior year included a loss from discontinued operations associated with the fresh vegetable business, which was divested in August 2025. Looking now at the non-GAAP performance measures. Adjusted EBITDA was $117 million, a decrease of $20.4 million, mainly driven by the higher costs within fresh fruit and partially offset by another strong performance from Diversified Americas. Adjusted net income decreased $9.4 million, predominantly due to the decrease in adjusted EBITDA, partially offset by lower interest expense and a lower tax charge. Adjusted diluted EPS was 46 cents compared to 55 cents in Q2 2025. Turning now to the divisional updates, starting with fresh fruit on slide 13. Revenue of $972.8 million was broadly in line with the prior year, as higher banana volumes in Europe and higher underlying pricing in North America was partially offset by lower banana volumes in North America and lower pineapple volumes across all markets. Adjusted EBITDA decreased by $22.5 million to $50.3 million, primarily reflecting elevated fuel and shipping costs, higher fruit sourcing costs, higher pineapple growing costs, and the continued depreciation of the Costa Rica colon. In Diversified Fresh Produce EMEA, reported revenue increased 1%, primarily due to favourable foreign exchange and underlying growth in Scandinavia, partially offset by lower revenue in Spain relative to a strong comparator quarter. On a like-for-like basis, revenue decreased by 1.7% or $19 million. Adjusted EBITDA decreased 6% compared with a very good performance in Q2 25, as continued strength in Scandinavia and a favourable foreign exchange impact was offset by weaker performance in South Africa, the Netherlands, and Spain. On a like-for-like basis, adjusted EBITDA decreased $4 million. Finally, Diversified Americas delivered another strong result this year. Revenue increased 14%, driven primarily by higher volumes in North American business, particularly kiwi, avocados, and North American cherries, together with more positive season-end pricing for our Southern Hemisphere export business. Adjusted EBITDA increased by $5.2 million to $20.6 million, driven by a strong performance in our North American business, together with the continued benefit of the partial restructuring of our berry operations in the fourth quarter of 2025. Turning to slide 16 for a view of key cash items and net leverage. Capital expenditure was circa $25 million, including investments designed to support future growth, expand capacity, and improve operating efficiency. For full year 2026, we are maintaining our guidance for routine CapEx of approximately $100 million. As expected, working capital remained an outflow during the first half of the year, reflecting the normal seasonal profile of the business. However, as discussed in our Q1 call, first half free cash flow significantly improved compared to the prior year. Net debt in the quarter was impacted by the first step of the Ecuador Port sale transaction. As part of that transaction, we completed a pre-closing ownership restructuring in May, acquiring the remaining minority interest in the port business. The second and final step closed on July 1st, and the associated proceeds will be recognized in the third quarter. Overall, net proceeds are now expected to be approximately $95 million. We ended the quarter with net debt of $746 million and net leverage of 2x, reflecting the completion of the Ecuador Port sale on July 1st and the expected net proceeds of approximately $95 million. Pro forma net leverage would have been approximately 1.6x at quarter end. This remains a conservative level of leverage and provides us with significant flexibility as we continue to execute our capital allocation strategy. Now, I will hand you back to Rory, who will provide an update on our outlook for 2026.
Thank you, Jacinta. So looking beyond the quarter, we are very encouraged by the strength and diversity of our portfolio, the quality of our market positioning, and the strategic progress achieved during the first half of the year. As we move into the second half, fuel and shipping costs remain elevated and geopolitical developments continue to create uncertainty. While some of the sharp cost increases experienced during the second quarter appear to be moderating, the operating environment is still complex. Consumer demand across our key markets has remained resilient, supported by long-term health and wellness trends. We also expect to benefit from contractual pricing mechanisms and cost-saving initiatives in fresh fruit, the effectiveness of our dynamic pricing model across the diversified businesses, and positive returns from recent investments and development activity. Taking all these factors together, we are targeting full-year adjusted EBITDA of approximately $400 million for 2026. And with that, I'll hand you back to the operator to open the line for questions.
We will now begin the question and answer session. If you would like to ask a question, please press *1 to raise your hand. To withdraw your question, press *1 again. We ask that you pick up your handset when asking a question to allow for optimum sound quality. If you are muted locally, please remember to unmute your device. Please stand by while we compile the Q&A roster. Your first question comes from the line of Christopher Barnes with Deutsche Bank. Your line is now open. Please go ahead.
Hi, good morning, good afternoon. Thanks for the question. First, I guess, could we just start on the EBITDA guidance? I know now it's approximately $400 million, down from at least $400 million before, but I just want to get more perspective on what you're expecting for the second half. Well, last quarter you mentioned that the second half would always be the stronger the half for the year, given the pricing, fuel surcharge recoveries, and other opportunities to take out costs division by division. But I guess, are you able to size in the second quarter how much of a headwind was the fuel cost versus recovery mismatch this quarter? And as we sit here today, like, how should we think about those benefits in 3Q relative to higher fuel and logistics costs and other inflationary pressures you might be incurring currently? Thanks.
Okay, thank you, Christopher. Yeah, I mean, I think the main problem we've got here is that it's just such a difficult backdrop on which to predict anything. Certainly, if you look at the world, you look at the general impact on fuel prices, on fertilizer prices, knock-on effects to inflation, consumer impacts. I think there's an overwhelming incentive around the world to try and solve this issue, but it's dragging on longer than we would have liked, and that obviously has some impact on our ability to get clear visibility over the back half of the year. We've put all the factors into the mix. We do have fuel surcharges that come in a quarter in arrears, and we will see the benefit that flow through in Q3, and then with the way pricing has been of fuel, likely to be a similar benefit in Q4. Some negative impact in Europe where fuel's been a little bit higher versus where we would have liked it to have been, but there's some offsets and ups and downs. So I think really just, Christopher, just the backdrop for being very precise about forecasting is just remains so complex that, if we can achieve a $400 million EBITDA outcome with all of the challenges that are being thrown at us at the moment, I think it'll be a pretty satisfactory outcome for the full year. And, we expect that to be split across Q3 and Q4.
Understood. Thank you. And just switching gears, how are you scenario planning around potential disruption related to a super El Nino on your banana and pineapple businesses? I know in the past you've mentioned improved irrigation for some of the drought-prone areas and better drainage where flooding might occur, but any perspective on contingency plans in place at your own farms or those where you're sourcing from would be helpful. And if you're willing to offer any insight into how protected or exposed the broader industry might be, that'd also be helpful. Thanks so much.
Johan will deal with that, Christopher.
Yeah, Christopher, firstly, you mostly actually answered the question yourself, which is good. We appreciate that. But remember, weather is not new to us. We farm in the tropics. Managing weather is what we do every day. And also, this event is building. We don't know any potential or how potentially strong it will be. It's just starting to build as we are speaking. However, also the pattern is well understood. Ecuador will get more rain, Ecuador and northern Peru. Central America and Colombia will be drier. And we have been building resilience for this for a long period of time, not only us, but also the industry as a whole. But we've been building resilience by expanding irrigation in areas that are likely to be more dry. We've been building dikes and drainages in areas that are likely to be more impacted by rain. We elevate up pump stations so they're not at flood levels. And also, if you take some of the other products, not talking about bananas and pine nuts, but if you take grapes or if you take berries, which we are not as exposed to as bananas and pines, the farmers that we're working with are experimenting with new varieties that are more tolerant to drought and to weather overall, to drought and rain. On top of that, we are building our portfolio when it comes to being diversified. So we have a lot of the volume south of the equator as well as north of the equator. So when you put all this together, we are keeping an eye on it, but we are not losing sleep on it right now, Christopher.
Great. That's very helpful. Thanks so much.
Your next question comes from the line of Gary Martin with Davy. Your line is now open. Please go ahead.
Hey, Rory, Jacinta, and Johan. Just a few questions on my side. I'll start with the capital allocation just to begin with. And I'm cognizant that you bought back shares during the quarter. How do you think about just general capital allocation into the future and just kind of weighing the different return differentials between choices of capital usage, be it more organic investment in the Scandinavian area versus buybacks versus other potential M&A? How do you kind of think about that whole picture? That's my first question.
Yeah, thanks, Gary. I mean, I think as always in the question of capital allocation, we do take a very dynamic approach to it. So I think the dividend is well established and we've held our dividend at a decent level. It gives an acceptable yield. Most of our shareholders are happy with that. There clearly are some small bolt-on acquisitions that very obviously give the right level of return compared to buybacks. We've some development capex, and I suppose you look at Scandinavia, it's a combination of a small acquisition. It gave us a strong platform. It's a smallish business, some $250 million revenue business, but has a very attractive facility that we believe we can utilize much better for the future development of our business. Over the last while, we've enhanced our investment at the production side and strengthened our position in production JVs. Across our European business, we've been upgrading our ripening facilities in Ireland, in France, in Spain. Normal growth, small add-on developments, all part and parcel of the ongoing and continuing and successful development of the group. So I think, we look at everything. We look at the investment return opportunities. We obviously look at the interest rate environment that's out there at the moment. We look at our free cash flow development from our business. And, we make some variable judgments around all of those factors. we've carried out, an element on the buyback program. I think since we announced it last November, something like a $15 million dollar buyback so far, with a consistent dividend. So the return to shareholding, we think, is sensible and reasonable. But it's a dynamic process. I think we had flagged obviously the Scandinavia investment, which is probably one of the longer term, more significant uses of the Ecuador, a very strong and 95 million net proceed outcome as well. So I hope that covers it, Gary.
I do have a part two, Rory, just on that,
Sure.
Just on your answer there, just around the general returns profile of, we'll say, some of that organic investment in Scandinavia. And I know that you called out AI and automation spend in particular. I mean, how does that sit premium to the overall average of Dole right now? Like, is it materially higher in terms of the opportunity set?
Yeah, I mean, our business is not one where we've quantum leap growth by making investments. We have a target level of return, and I guess the easiest way to look at it is we measure what our return would be against buybacks, and we try to ensure that our investments get a return that's a reasonable premium to that return. And we would like to grow the business. We'd like to develop the business. So we think there are interesting elements across, particularly in Scandinavia, where we will go to a further level of automation in conjunction with some of our key customers in that area, where we will utilize the latest robot picking technology. We will utilize the latest AI developments that are there, and improve the efficiencies and strengthen both the profitability and our long-term positioning with our key customers in that marketplace, and hopefully get the right return to enhance shareholder value over the long term as well.
That makes sense. And maybe just to ask a different kind of line of questioning, just around the revenue performance in the quarter, and just expectations into the back half in particular. So just one for diversified North America in particular. It's been several very strong quarters now in a row. Are we expecting moderation at any point here? Was some of the performance, was it kind of timing based in Q2, and should we expect that to moderate into the back half?
We're not expecting any radical moderation in the back half of the year. I mean, we have had a pretty strong run in that division, fair wind in terms of the way seasons have fallen. So, no radical shifts, but there can be a few, as you know, Gary, a few ups and downs, but overall we're very satisfied with that division.
And then just on diversified EMEA and rest of world, it was a reasonably kind of flat to slightly negative revenue growth quarter. I'd just be curious, just on a kind of pricing pass-through perspective, was much of the was a lot of the headwinds just a weakness in South Africa, or was some of the price pass-through and knock-on elasticity? Or what's the best way to think about it?
I think there's a couple of factors. I mean, I think if you go back to last year, we had a very strong increase in EMEA, and we called it out as exceptionally strong. So to try and repeat that was always going to be a bit challenging. But I think the single biggest factor is our South African business, and it is the business that has the single biggest exposure to the marketplace in the Middle East. So it has quite a strong customer base in that region, and the magnitude of disruption that took place, particularly during the early part of the war issues, was radical, where your shipping in its entirety stopped, reorganizing shipping. In the main, across the remainder of that division, it takes a little bit of a time lag to try and reflect the price changes. But in the main, we've been able to adjust the dynamic pricing, as we have always been able to do within that division. And South Africa really was our standout issue.
That makes sense. And then just to top it off, I'll cover fresh through here, just on the revenue growth perspective as well. There's just one piece in particular that I'd just be interested in, and that's the negative volume print in North America on the banana side. Is there anything that you call out in particular there? I know you kind of give a bit of color in the prepared remarks, but are you seeing any demand attrition here in the US?
I don't think so. And maybe Johan could give a little more flavor around that.
Yeah, no, we see demand holding stable in North America. Because of weather, pine volumes were down overall in the industry. That impacts it. And we've been careful when it comes to just protecting price in negotiations. That's it. Volume overall in the market's good, demand good. consumers still loving the products.
Very good. One final one from me then. Maybe it's one for Jacinta in particular, just around the first half's operating cash flow performance. Back a bit, I'd just be curious, just kind of the way to think about net debt at year end, or just the kind of general moving parts around the puts and takes of H2 operating cash flow performance would be really useful.
Yeah. Hi, Gary. Yeah. So as you recall, we always have a operating outflow in Q1 and Q2, and then typically experience a significant inflow in the second half. And we expect a very similar cadence for this year. So far, I mean, last year we had lower operating cash flows, but this year we expect it to be more normalized. And so far, that's the way it's played out. I mean, in terms of our net debt at the end of the year, obviously we've got the benefit of the port proceeds now. So yeah, we would expect leverage and net debt to be down at the end of the year. You know, hard to predict, but I'm guessing south of 1.5 times in terms of leverage.
Perfect. Makes sense. I'll pass it on.
Your next question comes from the line of Pooran Sharma with Stephens. Your line is now open. Please go ahead.
Good morning and good afternoon. Thanks for the question here. Rory, I wanted to kind of get at something you had said earlier in relation to guidance. I think you said, 3Q and 4Q split for fresh fruit, and wanted to just confirm that, because I know in the past, seasonally margins seem to wane from 3Q to 4Q. But I think last year, the business was facing pressure starting in the back half of the year. And so are we expecting the margins to be kind of similar through 3Q and 4Q and not exhibit that seasonality like we've seen in the past?
Yeah, I mean, thanks, Paul, for the question. I mean, we've over the last year, certainly the world circumstances have been a little bit different, and there's a few factors. I guess last year, in the back half of the year in particular, there's a whole range of unusual dynamics around short production in Honduras, short production in Panama, a huge increase in the cost of fruit coming out of Ecuador, which tends to be the safety valve, and the impact of that certainly had a strong impact on our back half of the year last year. We're not expecting that dynamic to repeat in Q3 and Q4, and on top of that, then we see the delayed benefit coming in from our specific contractual adjustments around bunker fuel surcharge. So yes, we do expect the margin dynamic in Q3 and Q4 in fresh fruit to be different to Q3 and Q4 of last year.
Okay, great. I appreciate the clarification there. And then just on the follow-up, just want to zoom out and think about the fresh fruit business. I think in the past, this has been described as a 5 to 6% EBITDA margin business over time. And just want to think about the changes in sourcing, freight, just some of your own production footprint over the last couple of years. Wanted to ask you if you feel like this is an appropriate normalized margin rate, and what you think it would take to get back to this level.
Yeah, we'd like it to be a little bit higher, and our aspiration internally is to try and push it up a little bit higher. Over the last few years, I suppose Honduras was the biggest single impact that affected us at the end of 24 and into 25. That production is coming back in stream, and that, generally speaking, because of the way it links in with our logistics and shipping structure, and the cost of production in Honduras tends to give us a particular advantage that goes to margin. So, and we've invested as I highlighted earlier, in a couple of production JVs, particularly in Guatemala. We've invested a little bit in plantains. I think pineapple margin as well within that has been under a bit of pressure, just with some short-term climatic issues that affected the production and quality sizing yields in pineapples in the short term, but that happens periodically and tends to balance out. So we certainly could do with the world being a bit more calmer, and the volatility around fuel prices, shipping prices, etc., a little bit unhelpful. But with a bit of a fair wind, the world will settle down, and some of those production issues, we'll see the benefit coming through and try and push back up the margin a little bit to what our normal aspiration should be.
Great. I appreciate the color. I'll get back in the queue.
Thank you.
There are no further questions at this time. I will now turn the call back to Rory Byrne, CEO, for closing remarks.
Thank you. Yeah, well, I think we're very pleased with the progress the business has made during the first half of the year. No doubt that the operating environment remains complex. Our teams are continuing to execute well against the backdrop of a difficult environment. Our strategic priorities remain very clear, and we're focused on delivering sustainable long-term value for our shareholders. Really would like to thank all of our employees right across the group for their continued dedication and hard work to the group, as well as to our shareholders, customers, and suppliers for their ongoing support. So thank you all for joining us today and for your continued interest and support of Dole plc. Thank you very much.
This concludes today's call. Thank you for attending. You